Hi, I'm Tom Kozlowski. I'm one of the partners with Lighthouse Wealth Management. With me today is another one of my partners, Henry Becker, who's also our Director of Research. Today we wanted to update you a little bit on what we see happening in the financial markets, given the elections right around the corner, and also a lot of talk about an interest rate hike. Normally our monthly video is a little bit shorter than this is going to be, but we think with the importance of what's happening out there, that it's going to be well worth your time. So with the election right around the corner, we've already seen volatility pick up as the market's trying to interpret what to make of a Trump win or what to make of a Clinton win. And so what we see is if Trump appears to be winning or is going to win, we see the market to drop off in the short term right after the election. The market hates uncertainty, and obviously not knowing whatever side of the aisle you're on in politics, not knowing exactly what policies Trump is likely to implement. The market hates uncertainty, and I think you'd see a bit of a sell-off in the market. And then conversely, I think you would see that money flow into bonds because there's a flight to safety until people feel more comfortable with what's going to be happening. In the short term, if Hillary Clinton wins, I think you're going to see the market rally because, again, there is certainty. People kind of know what they're going to get with Hillary Clinton, similar policies actually as we have today. We think that, again, the market would rally, but that actually it would clear the way for the Federal Reserve to raise rates in December. They raised them a year ago in December. They've been talking about raising them all year, and we think that if the market was up, that this would give them some good cover to be able to go ahead and do that. Now, for the longer term, of course, depending on if Trump were to be president and he were to implement some of his policies, such as less regulation, lower taxes, we do see that the economy could take off during the midterm, 2017, 2018, and that would boost GDP, which would be good for jobs. The one thing that we also see, though, is that he really has very little discipline in spending, and we could see that the debt get blown out even a lot more. Of course, if Hillary Clinton gets in, again, depending on the policies that she's putting in, but we typically would see higher regulation. She's proposing higher taxes, which does not necessarily help lift GDP, and therefore we think we'd see similar types of economy as we have over the last couple of years. So our view of the markets and investing right now is that everywhere we look, whether it's stocks, bonds, international investing, real estate, it's really hard to find any area that we can say is undervalued or a great buy right now. Here's a chart of the S&P 500. As you can see, stocks hit a few months ago hit a high and are only a few percentage points underneath that. The bond market's even more stretched. Here's a chart of the 10-year Treasury yield over the last 30 years. If yields are at an all-time low, then bonds are at an all-time high. Many of us can remember, those of us who are old enough, 30 years ago when CDs were paying 14%. Personally, my first mortgage was 11 3/4% in 1986, and I actually thought I got a great rate at the time, and it was. This past summer, the 10-year Treasury bond, which again is viewed as the benchmark for bonds and interest rates, hit the lowest it's ever been in our country's history, and it was hovering around 1.35%. Because of the low interest rates around the world, we believe the risk, here and around the world, we believe that the risk in bonds is near an all-time high. The low interest rate environment, in our opinion, has caused various asset classes to be valued higher than they would be if rates were normalized. So here's an example of what we're talking about. Aunt Tilly, very conservative investor who retired in the year 2000. She's 62 years old. She had $1 million in her bank IRA, which she invested in various CDs, and she was earning 6% per year or $60,000. That, combined with Social Security, was allowing Tilly to enjoy retirement virtually with no risk. But we fast forward that today, if Tilly had the same $1 million in CDs, she would be getting closer to 1% or $10,000 per year. So the conundrum, how does Aunt Tilly survive on that? What does she do now? She's 15 years later, she's age 77, if she still needs $60,000 to live on.
So that leads us to the dilemma that, us as financial advisors, pension fund managers, investors, savers alike, just like Tilly, find themselves in. How do we generate return without taking undue risk?
Thanks, Tom. I'll pick up the conversation from here. I want to spend a few minutes talking about the investing markets and investors and how they've changed over the past few decades. And I'll tie this into our current view of the markets. Now, I'm sure you've probably heard the boiled frog syndrome story, where a frog placed into a boiling pot of water will immediately jump out. As well, if you were to place a frog into cool water, he would sit there, and if you slowly turn up the heat, he'll remain there and get cooked. Further, I'm going to explain what I call the altered investor syndrome, and to do this, I'm going to use a slide deck that I think will be more beneficial than spoken word. In this first chart, we have what I call the investment risk spectrum. Reading from left to right, we have the most conservative investments, cash and bonds and so forth, and going up in aggressiveness to commodities and collectibles. And aggressiveness we could also equate to as riskiness. In the ideal world, we would have all of these potential investments to choose from to build a portfolio. But currently, you could allocate money to any of these investments, but in the negative to zero interest rate environment that we are in, the left side of this chart presents a not so good risk to reward relationship. For example, it's probably not the best idea to loan money, meaning purchase the bonds of heavily indebted Italian and Spanish governments that are paying just 1.4% on their 10-year bond, meaning they're paying investors 1.4% to loan money to them for 10 years. They're not the greatest credit risk, so there's a distortion in there. Or worse yet, is it a good idea to loan money to the Japanese government that's probably one of the most indebted nations on the planet, especially in the Western world, and at the same time you're paying for the privilege, because that's what negative interest rates mean. It means you're paying for the privilege of loaning someone or some entity money. So the bottom line is that a good bit of the left side of this chart represents a not so great risk reward. So this leaves us with only higher risk investments to grow our wealth. In this next chart, we'll get more to the point about how markets and investors have been slowly shifted to taking more risk for the same return. This graph appeared in the Wall Street Journal in an article back in May of this year titled "Pension Funds Pile on Risk Just to Get a Reasonable Return." What we see is that back in 1995, an investor seeking a return of 7.5% only needed to invest in a portfolio of bonds. Obviously, the expected return at 7.5% and a standard deviation of 6%. Standard deviation being how far something swings from its mean, whether it could. So basically, this return could have been as low as 1.5%. Or as high as 13.5%. That's what standard deviation means, variability around a return. By 2005, the interest rate environment had changed following the dot-com disruption, where bonds, the 10-year U.S. Treasury rate, had gone from 8% in 1995 down to 4% in 2005. So, for an investor to continue to earn that 7.5% return, the relatively safer bond portfolio had to be reduced from 100% down to 52%. So more or less, the other 48% had to go into riskier assets to continue to earn that 7.5% return. And we know the risk has picked up when we look at standard deviation. It has now jumped from 6 to 8, almost 9%, meaning this return could be as low as negative 2.5% or as high as 16, 17%. Further, by 2015, for the same investor to earn a 7.5% return, the bond portfolio that started at 100% of the portfolio is now just 12%. This is the relatively safe part of the portfolio has been reduced to 12% to continue to earn that 7.5% return. So where's the other 88% of the money going to? Well, it's had to go to large cap U.S. stocks, small cap U.S. stocks, foreign stocks, real estate, private equity. These are all riskier investments. And we know they're riskier because we can look at the standard deviation of this portfolio compared to back in 1995. Same 7.5% return, but look how much risk the investor has to take from 6 to almost 18. We'll call it almost 3 times the risk to get the same return that you could have gotten safely 20 years ago. This small chart is a great visual of what we call the altered investor syndrome. Whether you realize it or not, the investing risk-reward ground has shifted right under your feet. Obviously, we realize this, and this is also the reason we approach investing client money with caution. So the bottom line is, our clients, we believe our clients, hire us to make informed risk-reward decisions, as any investor should. And this is the difference between gambling and investing, making informed risk-reward decisions. So, once an investor realizes that they're being asked to take more risk for the same return, they have to come up with an answer. And that answer comes in the form of deciding how much risk they want to take with their portfolio. So for us, this is why we take a cautious approach to managing client money. And it also helps us not to become the frog in the pot of water. As always, if you have any questions, issues, or concerns, please feel free to contact us with anything you might need.